Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
That will about do it for my presentation. I'd be happy to answer any questions. As I mentioned, we do have our own webinars at TradeKing, and you can visit us at webinars.tradeking.com, and you can get a copy of tonight's slides at webinars@tradeking.com. My name is Nicole Wachs. I'm Director of Education for TradeKing. We'd love to see you on our platform, and just pass this back to John, and thank you for allowing me to be here.
Thank you so much, Nicole. Really appreciate you taking the time to come on and talk to people. But I did get a couple of questions. I think they were directed straight to me, so I just wanted to see if you got them. But one had to do with your probability calculator that you have on TradeKing's. I think it's on their site. And there was a question about how that probability is generated.
It's using what we use a log normal distribution. To cut that down into English, what that means is, if I say a stock that's $100 a share has an equal chance of going down $20 as it does up $20, so going down to 80 or up to 120, that may well be true, but the truth of the matter is that a $100 stock can only decline by $100, but it can go up by a lot more than $100. And so to account for the additional outcomes to the upside doesn't mean that the model is bullish. Okay, we're just talking about the potential outcomes that it can generate. Because of that, it gives a little bit extra skew to the upside, and it's slight, but it is important. And it comes out to like 0.02% sometimes. It depends on the type of trade you're looking at, but that is what is called a log normal distribution as opposed to a normal distribution. And most trading models will follow log normal because we're talking about stock prices or index prices that can go up to infinity, theoretically.
Okay. There was another question from Bob. He had... I'll just read it verbatim here. I find spreads between bid and ask on spreads in Condors or Butterflies to be very wide, and also having a hard time to get out of the trade early on in the strategies. Any suggestions?
That's a great point, and this is where the vehicle that you're trading is really critical. And the vehicle, I mean like the actual symbol you're trading. So you have to realize that when you're trading in a butterfly or a condor or any multi-leg strategy, you don't just have to cover the commissions to get in and out, but you also have to cover the difference between the bid and the ask prices. And obviously I know the person asking this question realizes this, but I just wanted to convey that to the rest of the audience because sometimes it's overlooked. And so that's why you want to be trading the most liquid product you can that meets the forecast or the estimates of what you think is going to happen. So you need the highest number of participants you can get in the market. So that's where we're talking about just pure volume of contracts trading. And you also want it to be trading in more than one place. You want it to be trading in more than one exchange. Now, another thing that you have to keep in mind is there are symbols, index symbols, and even other kinds of symbols, such as, say, ETFs, where you may want to trade this on a particular ETF, which is 1/10 of the big index, right? But the bid-ask spread on the ETF might only be a few pennies wide. The bid-ask spread on the index might be 10, 20, 30, 50 cents wide, okay, even maybe more. But what you have to realize is you're trading an option dollar-wise that is a lot greater in value, and so the spread between the bid and ask prices is going to go up in proportion to that, okay? And so, yes, I agree, it is painful to place that trade on a vehicle that has wide bid-ask spreads, but before you assess them as wide, make sure that you're really looking at it in the true sense. You know, if you're trading something that's wide and it's just wide, don't trade it. But if it's, you know, if you look at it and compare it to an ETF or a mini index that it trades on, you know, make sure that you're evaluating it fairly. Another thing to keep in mind is the more volatile the product is that you're trading, the wider the bid-ask spread will tend to be. And so not only do you have to deal with you know, you have to know what your stomach can handle on the fluctuation side, right? How much the index or the whatever the underlying is you're trading, how much it can move. But now you may get hit harder in trying to get out of the trade early because the bid-ask spread is even wider. And why is it wider? Well, maybe because it's not liquid, maybe because it is volatile, maybe because it's both. And so you just need to really think about these things before you get into the trade. So try and trade things that trade in more than one location, have lots of volume in the contracts trading, and don't focus so much on that particular month's volume, because if it's a brand new month that just came online after expiration, there's not going to be any volume there for you to look at. So don't worry about that as far as like what's happening in that particular month, but at least what the volume is overall. And you're going to want at least, say, you know, 1,000 contracts in volume, at least. I mean, a lot of these other products, you're going to want more, but, you know, and it all depends on what you're trading. If you're trading a one-lot spread and the open interest, you know, is 100 contracts, okay, that could work because you're only trading a one-lot spread, but, you know, obviously the lower the volume you get, the harder it is to manage that bid-ask spread.
Mm-hmm. And finding these trades, is there a scanner or anything that's available on TradeKing's site or within the interface for people to use?
Oh, that is a great question, John. We do offer 2 option scanners on our site. One is more basic, where it's just focusing on individual options, like just one strike at a time. You know, maybe you want to trade a long call or a long put or a short call or short put or something like that. And then we also have a strategy scanner that you can put in, like you're looking for condors with a certain type of implied volatility range, and you know, you're looking for a certain type of probability that you want for the trade. And so you can put in several of the parameters that I talked about tonight, and it will give you some potential trade candidates for you to examine.
Okay, good. A couple other questions have to do with the differences between the Condors and Butterflies. Basically, are one of these better to do after, you know, a major event or something in the news? Do you have an idea which, you know, might be better for a trader?
So somebody's saying after the news has passed, what might be better?
Yeah, after, like, if the news just came out, is there one of those strategies that seem to work better when you see the underlying moving, you know, with the news?
That's tough to say. I mean, because there's different factors that go into this, but one of the things that might be happening is that after the news is released, the expectation is that implied volatility will go down. Because it's kind of like the cat is out of the bag scenario. So, or the surprise that occurs at the surprise party, right? You don't want to get there after the guest of honor arrives. Mm-hmm. So you would expect volatility to be declining. Mm-hmm. If that was the only thing you were considering, then the butterfly would be the better candidate, because when you sell those 2 at-the-money options, you're making more of a volatility bet that it will decline. But you do need the underlying to be stable in value so that it's not moving outside of the break-even range. Mm-hmm. if you were unsure about the stability of the underlying, and you thought that volatility would decline, but you really weren't sure on the range of the underlying, but maybe you had a feel for the direction of it, or at least maybe not where you thought it was going, but where you thought it wasn't going. Mm-hmm. So then you might actually just want to use one half of the iron condor, which would be either a short call spread or a short put spread out of the money variety.
Okay. One last question. Since iron condors have a higher probability, why do butterflies? I think that really depends on what you input though into the tool.
Sure. Could you repeat that again?
Yeah. It just says since iron condors have higher probability, why do butterflies?
Oh, maybe why do butterflies have lower probability? I mean,
right. Yeah. Well, why, since the iron condors have a higher probability than the butterflies, why even do butterflies? For some of the, I think with the probability calculator. Them. Yeah.
Okay. Sorry. Okay. So why trade them?
Mm-hmm.
It all depends on, right, probability is only one aspect of the trade. You still need to consider the risk and reward, because with a condor, if you have a 10-point spread that you're doing, you're looking to make $2 and risk $8. With the butterfly, you may be looking to risk 16 to make, risk 4 to make 16. Or risk 5 to make 5. It all depends. The other thing is that if you have an expectation of volatility dropping rather quickly, but the instrument remaining stable, the butterfly trade would outperform the condor trade in that scenario.
Okay. Well, Nicole, thank you so much for coming on. I know we got a lot of good questions. I think people are really engaged, so I really appreciate it. And is there anywhere, so you said everyone should go to webinars.tradeking.com to check out the rest of your webinars that you have. Is there, we don't have any, just to let everyone know, ISE doesn't have any webinars scheduled right now for 2011, but we will be having some coming out soon. So sign up for our emails, and we'll be sending those out. But Nicole, I just wanted to thank you again for coming on.
Oh, thank you so much, Don. It was my pleasure, and I really appreciate the chance to speak with everyone here. Thanks again. And have a great holiday season.
You too. Thank you. Bye.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.